Welcome back to Investing Talk podcast. Today we're taking a focused look at Host Hotels and Resorts. Now, one of our listeners actually sent in quite a bit of information. We've got analyst reports, news clippings, Host Hotels' own releases, and they basically wanted to know, what's the key stuff happening right now with this major player in the hotel industry? So our mission today is really to unpack all of that for you. We want to pull out the crucial insights without getting bogged down in the details. Think of it as your shortcut to getting a good handle on what's going on with Host Hotels.
Okay, so maybe let's start with a quick overview just to set the scene. Host Hotels and Resorts, they are the world's largest publicly traded lodging REIT. That's real estate investment trust. Their focus is very much on luxury and upper upscale hotels, and primarily we're talking major U.S. markets. Their strategy fundamentally is aiming for top-tier EBITDA growth. They try to achieve that through, well, their significant scale and pretty active asset management. And people often describe their properties as iconic, irreplaceable, prime locations across the U.S.
Right, iconic properties. Okay, let's get into the more recent stuff then. We know their Q1 2025 earnings call is coming up, right, May 1st?
Yeah.
But they did give some guidance back in February for the full year 2025. What were the kind of headlines in that update?
Well, the February guidance, it pointed towards comparable hotel total RevPAR growth.
Okay.
That's revenue per available room, in the range of 1.0% to 3.0% for the year. And they also projected JEP revenue between, $5.996 billion and $6.102 billion, which, represents a pretty decent year-over-year increase, about 5.5% to 7.4%.
Okay, that revenue growth sounds pretty positive, I have to say.
Yeah.
But I also came across some notes suggesting maybe a squeeze on their profit margins. What's the story there?
Yes, that's a really important point to flag. Their own projections do indicate a noticeable decline in operating profit margins. They're estimating between 11.8% and 12.6%. That's down around 300 basis points. And similarly, the comparable hotel EBITDA margin, they see that shrinking too, down to 27.2% to 27.8%, which is about 180 basis points lower.
Wow, okay. So revenue up, but margins down. Did they say why?
They did. They specifically mentioned headwinds from wage inflation and rising insurance costs. And this kind of margin pressure, if it continues, well, it could potentially make it harder for them to fund things like future acquisitions or big capital projects without, taking on more debt. So that's definitely something you'll want to watch closely in that upcoming Q1 report.
Got it. So more money coming in the door, but it's costing them more to run the places, essentially.
Well,
that makes sense. Were there any other sort of operational things happening?
Yes, a couple things. They mentioned the ongoing restoration work at the Don Cesar. That was damaged by a hurricane, remember? So that's still underway. And also their investment in the Four Seasons Orlando condominium project, that's continuing as well. These are, fairly significant projects that could definitely factor into their results over the next little while.
Okay. Now, maybe let's zoom out a bit. What's the bigger picture? The operating environment for Host Hotels, what are they seeing out there in the market?
Yeah, the market dynamics are quite interesting right now. It seems like a bit of a mixed bag, actually. Host is observing what they call a bifurcated demand recovery. So group business think conferences, events that seems to be improving steadily. Business transient, so individual work trips, that's coming back, but maybe more gradually. And then leisure travel, which had that huge surge after the pandemic, that seems to be stabilizing now, kind of finding its level.
Stabilizing. Okay. Not necessarily falling, but not booming like before.
That seems to be the idea. And it's also really important to remember they're not alone in facing cost pressures. A lot of their competitors are dealing with similar things like rising real estate taxes and, as we mentioned, those higher labor costs. The wage inflation piece really highlights how tight the job market still is in hospitality. That could be a persistent trend affecting other hotel REITs too.
Right. So those cost pressures aren't just a Host Hotels problem. Good context. So on the flip side then, where does Host Hotels really shine? What are their core strengths?
Well, first off, their size. As the largest global lodging REIT, that scale gives them, significant advantages. Could be better negotiating power, maybe operational efficiencies, things like that. They also have that very diversified portfolio we talked about. Premium hotels, prime U.S. locations. That geographic spread helps mitigate risk,
Reduces exposure if one area slows down.
Precisely. And they're also known for having strong corporate governance and a pretty experienced management team. Seems focused on long-term value. Oh, and there's the sustainability angle, too. They've been on the Dow Jones Sustainability World Index for 6 years running now. That suggests a real commitment there.
Okay, those all sound like solid pillars.
Yeah.
But of course, every investment has potential risks. What are some of the challenges or headwinds that host hotels might be facing?
Good question. That relatively modest RevPAR growth guidance, the 1 to 3%, while it's still growth, it might suggest they're being a bit cautious, maybe because of inflation or just some uncertainty about how travel demand will hold up.
Makes sense.
And their concentration in U.S. luxury hotels, while often a strength, could make them a bit more vulnerable if there's an economic downturn. High-end travel is often the first thing people cut back on.
Discretionary spending, right?
Exactly. Then there are the ongoing property risks, like we mentioned with the Don Cesar in a hurricane zone. That's always something to consider. And we keep coming back to it, but those rising wage and insurance costs are definitely squeezing margins. That's a big one. And finally, they did issue $900 million in senior notes last year, so there's some exposure to interest rate movements there too.
Okay. Quite a few factors to keep an eye on there.
Yeah.
How does Host stack up against, say, other big names in the hotel world, like Marriott or Hilton?
Yeah, it's useful to compare. Host's model is quite different in some ways. You see, companies like Marriott International and Hilton Worldwide, they have huge global footprints and mostly operate via franchising and management contracts. They don't own most of the actual buildings. Host, on the other hand, their main business is owning the real estate, those high-end U.S. properties.
So they're more of a pure play real estate owner in that specific segment.
That's a good way to put it. Marriott and Hilton have a much wider range of brands, different price points all over the world, much broader diversification. Host is really focused, very concentrated on that luxury and upper upscale tier, mainly within the U.S. So their fortunes are very closely tied to the health of that specific market segment.
Understood. So looking forward then, what are the key things that could really move the needle for Host hotels? What are the catalysts we should be watching?
Well, number one is definitely that upcoming Q1 earnings report on May 1st. That's going to give us the latest financials and, crucially, any updates or changes to their outlook for the rest of the year. Beyond that, just the general continued recovery in travel demand is key. That includes both leisure and, importantly, that gradual business travel comeback. Improvement there should help them slowly improve occupancy and maybe gain a bit more pricing power.
Okay, so if we try to wrap all this up,
Mm.
put it all together, what's the overall picture you're getting of Host hotels right now based on everything we've discussed?
My take is that it seems like a fundamentally solid company in its niche, the luxury lodging space. It definitely benefits from its large scale and what appears to be disciplined management. However, that near-term growth outlook is, let's say, moderate, not spectacular. And those margin pressures we talked about are real and quite evident. So it probably suggests that, a somewhat cautious stance might be warranted, at least until we hear what they say in that Q1 earnings release, get a bit more clarity. But for you, if you're specifically looking for exposure to premium U.S. hotel real estate, and maybe that sustainability focus is important to you, then Host hotels could still be quite an attractive option to look into.
Right. So what does all this really mean for you, the listener? Hopefully this look into hotels and resorts has given you a clearer picture of where they stand today. Challenges they're navigating, but also their potential strengths. Definitely keep an ear out for that Q1 earnings call May 1st. The details they share there will likely tell us a lot more about where they're headed. And remember, really understanding these fundamentals is just so crucial for making informed investment decisions.
And maybe think about what stood out most to you listening to this. Are you perhaps most interested in how that business travel recovery might play out for these luxury REITs? Or maybe it's the longer-term impact of inflation on the whole hospitality sector. Let us know your thoughts. We'd genuinely be interested to hear what aspects you're curious about.
Yes, absolutely. And if you found this analysis helpful, please do subscribe to Investing Talk Podcast and maybe leave us a like or comment. Your feedback really does help us figure out what topics matter most to you for future discussions. Thanks very much for tuning in.